Hi everyone. In the previous video we started looking at how to record transactions, and we specifically look at what happens when an owner invests in the company, and then what happens when the company purchases property and equipment for cash. So these are these two transactions that I'm going to hide for now, because we are going to look at the third transaction, which is the company is paying $3,000 cash for rent of office space and facilities. So in this case, we know that the cash is going to decrease by $3,000, and since this is an expense, we are going to decrease retained earnings. Retained earnings is what the company keeps the profits after they pay dividends. It's going to decrease retained earnings. As I mentioned in the introductory video, any decrease in equity, which retained earnings is part of, any decrease is recorded as a debit. So we are going to decrease retained earnings. That's one way to do it. Another way to do it is to have the balance sheet on the side. Some professors teach you that you have the balance sheet on the side, and then you are going to record expenses on the side, and then you are going to come up with the income statement and write profit or loss into the retained earnings. Either way is fine. I'm going to stick to the balance sheet approach for now. In our fourth transaction, we are going to look at company performing services for clients and receiving cash. So when company is performing services and those services are delivered, we are going to increase cash because we are receiving cash, and at the same time we are going to record the revenue. The revenue is, any revenue is going to increase retained earnings. So in this case, we are going to increase retained earnings by $4,000. So this is what you record when you deliver the services or products and receive cash in exchange. Let's take a look at the fifth transaction. The company is performing services and billing clients for $10,000. In this case, we are not receiving cash. The clients owe the company $10,000. So we are going to increase accounts receivable by $10,000. And this is still revenue. So we are going to increase retained earnings by $10,000. And this part is fairly important. In our daily lives, we think of revenue when we receive cash. In accounting, that's not the case. When we deliver the services or products, we are going to recognize that revenue, regardless whether we receive cash, as in this example, or whether we bill the clients and the clients owe us the money. And in that case, as mentioned here, we are going to record that transaction under accounts receivable.